In this last video on options, we'll talk a little bit more about some strategy, and then we'll move on and talk about some different types of options rather than just the stock option from the previous videos. So here we have an example of something called a protective put, and this still comes under the category, if you will, of hedging or modifying risks. In this case, our objective is to try to protect some profit that we've earned. So to do this, we're going to purchase a put. And if you remember, a put makes money when the price goes down. And of course, if the stock price is going down, since the option goes up in price, dollar for dollar, that the stock price is going down in price, then the net effect is there's no loss. The value to the portfolio is the same. And again, this is a kind of insurance, if you will. And especially when market prices are falling, these put options can have a pretty decent premium to them. So above and beyond their intrinsic value, the time value, if you will, can be pretty hefty for puts, especially when the market is declining. So here we have an example. We purchased this stock for $35, and now the stock has risen to $75. So on this day, we want to buy a put. We're going to buy a 3-month put. Strike price is $75, and $2.50 is the value of this put. Now, if the price goes down, the put goes up in value. And of course, if the price goes up, the put goes down in value, or would ultimately just go to zero. So let's think about what happens if the stock price goes down to $50. If it goes from $75 to $50, that profit then is mostly going to be seen. $2,500 is the profit that we're going to get from the value or from the investment in the put. Again, it's going down what? $25 times 100 shares, dollar for dollar it goes out, so you'll make $2,500 in value for the put. Now, of course, you bought the stock for $35, you're going to sell it for $50, so you did make $1,500, but the purpose of this hedge is this occurrence of it going from 75 to 50. We actually lost $2,500 in value of our portfolio, but we made that up by making this purchase of a put. And of course, there is the cost of the put. So if the price goes down, in this case, we'll make $37.50 on the investment, even though we lost money on our portfolio. If the price goes up to $100, of course, the value of the put excuse me, the value of the put would be zero since we wouldn't exercise it, and the increase in value, so we went from 100, we bought it at 35, so we'd make 6,500. Again, we had to pay the premium, so we actually reduce our profit by a little bit, so we'd end up having a profit of 6,250. So these hedges, right, if you think about this thing, we can also set up hedges to limit losses on a short sale, right? Because on a short sale, if the stock price goes down, we make money. If the stock price goes up, in this case, we lose money. So if you buy a call, as the price is going up, the stock loses $1, but the call makes $1. So again, this would allow us to protect our short sale position. The other side of the coin that we really haven't talked much about as of yet is what happens to the person who is writing the calls, the person that's creating, or the seller, right? The seller is betting that the other person, the buyer, is going to be wrong. And if you remember, the only premium, the only profit the writer can make is the premium. So it's easy money if the option expires worthless, right? You can't make more than the fee you received, but if it goes worthless, that's exactly what you're going to earn. The risk is if the option's in the money, right? If this option is in a position where there's going to be some type of an exercise, then that creates potential risk for the person that writes the option. So a naked option is when the writer doesn't own the securities underlying. And to close out the exercise, they're going to have to buy them. No matter, there's no limit here on what the loss potential is. For a covered option, the writer actually owns the option securities. So the loss exposure is just limited to the price that they originally paid for those securities. So if we look here, we have the current stock price is $73.50 and the current price is $2.50. The price of the stock, if it's unchanged, then the value of the call is zero. They're going to receive some dividends. They receive some proceeds on the call, so they make $350. But what if the stock price goes up? The stock price goes up to $80. What's the value of the call? Well, the value of the call at a strike price of $80 is still zero. So again, the person who writes the call, they own the stock here, so they get the dividends, they get the proceeds of the call, and then they get capital gains because they have the stock of $80 from $73.50 to $80, so they make $1,000. Now, what if the price goes up to $90? The value of the call is $10. They receive the dividends. Here's the proceeds that they received. Here's the capital gains on the stock, so they made $16.50. And the loss on the call now, since this person's going to exercise the call, we're going to have to produce these stocks for the client, so we're ultimately going to lose this $1,000. So the net profit is $1,000. What if the price goes down to $71? Again, they refer to this as the break-even price, right? So in this case, you get the dividends, you get the proceeds, but you also have a capital loss on the stock of $2.50. So in this case, the net profit is $100, and that's just the dividends that you receive. So again, this is just an example of profit potential when you combine some securities together. Another strategy that we can talk about then is what's referred to as spreading options, or I just like to refer to this in general is creating portfolios of options, combining two or more options into a single transaction. Now, these options can differ in strike price and or expiration date. We have a variety of kinds of spreads. A bull spread is when you think the price is more likely to go up than go down. A bear spread is when you think it's more likely to go down or up. We have money spreads, vertical spreads, butterfly spreads, and many, many more. So the purpose of this is to take advantage of differences in the option prices and premiums. So each type is different. It's there to meet a certain type of an investment goal. If you think about a vertical spread, for instance, we're going to buy a call at one strike price and write a call on the same stock for the same expiration date, but at a higher strike price. In other words, what we're looking at here is the difference in that time value of that time return, right? Because since the stock price minus the exercise price of one, that intrinsic value compared to the intrinsic value of this other stock at the higher price, that's going to be different. And of course, there is that time value premium or part of the premium that is in each one of these transactions. So the payoffs can be substantial, but also the risk is substantial. So let's talk first about something called an option straddle. This is a simultaneous purchase or sale of both a put and a call on the same underlying common stocks. Now, straddles normally have the same strike price and expiration date. The objective here is to earn a profit from either a big or a small swing in the price of the underlying stock, depending on whether it's a long or a short straddle. In a long straddle, you would buy equal numbers of puts and calls. Short straddle, you would write equal numbers on each on the options or on the stock for the same stock price, the same expiration date. And again, in this case, for a short straddle, you make money when the price of the underlying stock goes nowhere, and you could make money on both sides. Of course, you're writing the option, so the only profit you can make is the premiums on the two. With the long straddle, since you're buying an equal number, of course, you know the profit potential can be a little bit higher when you buy than when you sell. But in the end, if you think about a long straddle, one of your, if you're, since you're betting that both the stock price is going up and down, only one of those can be true. So one of these investments is going to expire with zero value, and of course you would lose the premium you would pay on that. So you pay two premiums, and then you get the profit potential of either the put or the call that you purchase. Now, some other types of options are stock options, and index options themselves have been around forever, right? So you can buy a put or a call on a major stock market index. So the index option, again, it's written on a specific market index. Now, what's different with stock indexes and the other kinds of options is that these options you don't exercise these options and get stocks. When you exercise an option that is not a stock option, what you receive is cash. So the underlying settlement here is cash. And of course, index options can be American or European options. There's lots of options that you can choose. Here is an option chain for the S&P 500, and over here you see calls. Like the last price was $47.50. If you go across here, here was the bid ask. There was nothing traded this day, and for this strike price of $2,045, there's 473 options open and available. Likewise, for the puts over here, you see these puts down here are essentially going to be in the money. These puts up here are in the money. These are out of the money. So again, looking at and trying to determine which options to buy. Quite frankly, if you're speculating, what you're speculating on is the entire market index. You're not speculating on an individual stock. It's the market that you're speculating on. But if you have a very large portfolio, let's say you have a portfolio that's got 100 different stocks in it. Those stocks may very closely represent or follow, if you will, one of the stock indexes. In other words, maybe your portfolio looks an awful lot like or acts an awful lot like the S&P 500. And of course, you can do some statistics to see which index your particular portfolio seems to follow. And then you can buy options on your portfolio to protect it, just like you would if you were buying a stock and you wanted to protect profits there. So we have hedging activity and speculation with respect to indexes, stock indexes, just like we do with respect to individual stocks. So the market price is obviously the difference between the strike price and the market index value, right? So they're valued, they have characteristics just like any other put and call. Again, most broad best index options use full market value of the index for trading and valuation. Now the exceptions to this are the Dow Jones properties, right? They're slightly different in how they the values that they use to determine for purposes of trading and the valuation themselves. As I mentioned, you can index or hedge your entire stock portfolio, right? Now the cost of doing individual stocks can be very expensive, especially when the markets are falling and you're buying puts. So if you choose an index option, right, you can possibly save some of your profits at a much lower cost than if you were doing it for individual stocks. Again, a couple of cautions, if you will. Trading index option involves high risk, lots of volatility. As they say here, it's not for amateurs. You really have to watch these securities daily. They're, as they say here, they're not really buy and hold strategies, right? You have to monitor and keep track of these types of securities all the time, mostly because of their price volatility. Now, there are other kinds of options. We have options on exchange traded funds. So you can purchase, just like you buy on stocks, you can buy options on these exchange traded funds. And if we talked about exchange traded funds, they're a type of an index fund, sort of a mutual fund type of thing. And now you cannot buy options on regular mutual funds. But on these exchange traded funds, there are index options or options that you can ultimately buy on these types of securities. There are interest rate options. Again, what these are puts and calls on fixed income securities, on debt. Typically, they're only written on United States Treasury securities. So when you're investing in these, the change in return that you get is representative of the change in interest rates. Now, so here, as they say, you're going to track the return, the yield, not the price, when you look at investing in interest rate options. And again, options change with yield behavior of debt securities, just like stock option prices change with respect to prices in the underlying stock. There are currency options. Currency options, quite frankly, can be fairly popular. Again, we can do this for one of two reasons, speculation or hedging. But in this case, you're buying puts and calls that are written on foreign currencies. And they're available on most currencies. Again, the value of the currency option is linked to the exchange rate between the U.S. and the foreign currency. Not necessarily the currency itself, it's the exchange rate between the United States and that currency. And finally, there are things called leaps. Leaps are puts and calls that have rather lengthy expiration dates. They're long-term options, if you will. Frequently, what they do is these are sometimes tied to bond issues, right? So maybe we want to put a little sweetener in the deal to make it maybe the people that want to buy the bonds will buy. They like the bond, but maybe they're just on the edge. They don't know whether they want to buy or not. And maybe a company will add these leaps. And again, they're available on lots of different stocks, stock indexes, exchange traded funds. But again, they typically have a very long time frame, as long as maybe 3 years. They're loaded with time value, so they tend to be a lot more expensive, right? I mean, the general idea here is, since it has a long time period, the intrinsic value really doesn't change the day you buy it. It changes after you buy it, but that value is that value. It's very straightforward what the intrinsic value is. It's the time value that makes the big difference with respect to leaps. So you're really looking for something to change, but you're willing to wait for that price to change, and that's what makes it a little bit on the riskier side. So that's the end of our videos on options, puts and calls.